Trend following is a clunky brute force instrument. The trend is the condition, of the market. And in order for the math of trend following to work, you need multiple days to deliver a trend. You need to compound that over time. And there are going to be noisy days in between. They're just not a part of the trend.
Welcome to The Derivative by RCM Alternatives. Send it.
Hi, I'm Eric Leake, Altus Private Capital, here to talk about delivering better results through smoothing volatility.
Hey, Eric. How are you?
Good.
I need to know two things quickly. One, the guitar just for show, or you can play?
Oh, sorry. I actually didn't know I was there. I was cleaning up my office. No, I was a music major. I played guitar and other instruments for a long time. I thought I was going to be a rock star when I was in high school going to college. So there's some leftover for that. Now it's just mostly DJing and as a side for fun gig. But no, my guitar days are few and far between now.
Music major. Where'd you go to college?
Went to Azusa Pacific University, a little private Christian university in Southern California. Went there to play volleyball and study music. And the music major lasted, I think, a semester and a half. Two things happened. Number one, I realized that I had to, per the major, I had to sing in the all-male choir and travel around, and that was not going to work for me as an athlete. And I just didn't want to do that. And number two, I realized every other person in the major was way better than me. Everyone could sing better than me. They could play piano better than me. I realized, you know what? I don't think I want this to be my living. But music's always been a passion for me. It's always been something that I've been involved with and I'm still today involved with in various ways. So my daughter actually was a candidate on American Idol. She's producing an album. So music is definitely in the family.
Really?
It's still kind of around in various ways, but not my primary focus.
We'll put a link to we did a podcast with Roy Niederhofer, I think, the other one. He's way into music, but to me, there's a link between like the musical brain and the systematic quant brain. You think so, or yeah?
I 100% support that. I think that it's really almost about patterns and music. A lot of times in pop music, it's a formula. And there is a way of taking people from emotional, you build and then you have a transition and then you have a break and then you build the chorus. And so there's definitely some rhyming to how markets work because I think markets are a lot driven by, we'll talk about it obviously, but there's a lot of human psychology and behavior finance that drives prices. And there are times when markets are efficient, times where they're inefficient. But definitely, I'm not smart enough to figure it all out, but there's definitely a link between the patterns and the math of music and markets. I totally believe.
Well, that most people don't realize, right? Like the far end of music is math, really.
It actually is. It is.
I tell people that with philosophy and logic also. Like the far end of philosophy is actually, you circle back around to math.
Yeah, no, that's true. I think until once you study music and you're forced to sit in a classroom and study scales and keys and different triads and all those things, you don't realize how mathematical it is. I think music for people that haven't studied it seems like this magical, like, whoa, there are only about 5 chords that you can play. I could probably play 5 chords and sing 30 different pop songs you would recognize because it's the same math over and over and over again. It's very repeatable.
There's that famous, I can't remember who, some English group on YouTube that does that. They're like,
exactly.
All the favorite best songs of all time are just these 5 chords.
That song? Wait, that song?
That song?
Yeah.
And then the second non sequitur I forgot is your last name. It's spelled Leake, but you pronounce it Lake. So what's
Lake.
The background on that?
Yeah. I've been told it's Lake. Been that my whole life. I spent kindergarten. You get a substitute teacher. Eric Leake, is Eric Leake here? Like, it's Lake. Apparently there was a town outside of Yorkshire, England, that was Leake, and they pronounce it Lake. That's what I'm going with. That's what I've been told.
And not leaky. Leaky would be
leaky. Yeah. Sometimes I just mess with people and make a different. It's spelled La Croix. I just mess with people, but no, it's officially Lake. It's what it's supposed to be. But you can call me Smith, call me Johnson, whatever you want to call me. Doesn't matter.
Love it. And I was lucky enough to go visit you during Future Proof out there in beautiful sunny California. So give us a little where you live, why it's the best place in the world or not.
It's
Yeah.
definitely God's country. I don't know if it's the best place in the world. I've been to
All right.
better.
Yeah. One of.
But
Yeah.
we're in Laguna Beach, California. It is beautiful, and if I could point the camera out that way, you'd see the ocean. This is the hands down best time of year. It's total complete side note. If you're not from California, haven't been here, and you're thinking of visiting, you want to have your California summer vacation, come in August, September, and October. We have this crazy thing in June called June gloom. And so I always feel bad. You have folks in the middle of the country, Nebraska. Hey, it's June. Kids are out for summer. Let's go to
Go to
California and
California.
go surfing. It is your worst nightmare. It's like San Francisco in January. The fog comes in off the water because the water's still cold. This time of year, it's stunning. It's like 80 degrees. I mean, if you watched a football game yesterday with the Chargers, you saw SoFi Stadium.
Yeah, yeah,
They got murdered, by the way, but
yeah.
it is killer weather right now. So we're in Laguna Beach. I've been in Orange County, in South Orange County for 30 years. Went to, like I said, went to school at APU, came down here and found this area. I grew up surfing in Santa Cruz, and once I found South Orange County, the water's warmer, the waves are more consistent, the people are actually doing something with their lives and going somewhere. Most of my friends in Santa Cruz are kind of just hippies sitting on the beach. So I've been here a long time.
Who's to
Love it.
say who's right though? They're loving their life too, right?
Yeah, I mean, for me, this is more my lane. I think I have extreme ADD. If you can't tell, I need to be moving all the time. So I'm more comfortable here. Yeah, it's a great
Love
spot.
it. Did you ever surf Mavericks, right? Is that up there?
I did not surf Mavericks.
That's
I didn't
intense,
say I
right?
was
That's big
a
boy stuff.
fantastic surfer. I said I surfed.
Yeah.
So one of my good friends, actually, I won't name his name, but a very good friend from high school, he was one of the original Maverick surfers. He's actually in that movie Chasing Mavericks,
Nice.
and he's a great dude. But no, I don't. He told me a story one time about. I asked him what it was like to surf that, and he said at one point in training he was held down for so long after not hitting a wave the right way that the blood vessels in his lungs would burst, and when you finally come up with that vest, you're coughing up blood. Sorry if that's too graphic for this markets
No.
podcast, but
Yeah.
that is not for me. I am not
No. And
that guy.
then,
I'm a
yeah.
fair weather water surfer. Yeah.
How do you go back in the water after that? Like, oh, just a
I
few bursted lung blood
Yeah,
vessels.
it's a passion for these guys. They survive. I think that's the win.
And just because you told me this story, and I think it's cool, you had your own little sporting accident on the mountain bike. Give us the quick,
We're talking about that, really? I think we're gonna
yeah,
go
give
there.
us the
Yeah.
quick one. Yeah.
So rewinding, I grew up playing volleyball. I played in college. I used to coach one of the high school teams here, and getting down to the beach was just wasn't working. It was too far. I was living in Aliso Viejo at the time, so I picked up mountain biking. And yeah, about 4 years ago, we had some young kids take off in front of us, and they stopped in the middle of the trail, and I'm flying down, and there was nowhere to go, and I went off a cliff and went, it wasn't a good outcome. But I'm
Mm.
here today, and that's why we had. That's why we're helmets. So that's why I may sound strange as a risk manager talking about flying off a cliff, but that's why we have helmets and pads and things, and it was fine. A few stitches here later, a few stitches in
Yeah.
my chest. It was all good though.
We've
Yeah,
had him. Veneer Bensali's been on here talking about backcountry heli skiing and
yeah,
hiking into avalanche territory and stuff. So,
yeah,
yeah, you're a risk manager in your day job. It's fine.
that's right.
So, how did California boy end up in the markets? What was the path to get you
Man, I know it's
into
a
the
really strange
market?
story. So, like I said, I went to school thinking I wanted to do music, and realized pretty quickly that that was not the path for me in terms of a living. And I wound up in marketing and communication. And about that time, it was early '90s. For some reason, I started getting recruited by these financial advisory firms, and I thought, very young and stupid, that sounds really fun. I'll go try and do that. And
Hmm.
so. This isn't maybe the best story, but I was lifeguarding down at Salt Creek Beach, and they said if you can pass the Series 7, you can come to work for us. So I passed the 7 on the first try, and they said congratulations, you're a stockbroker. I was like,
Yeah.
And for
Woo!
probably about 5 minutes, I was fist pumping, and then after that, I'm like, "What does that mean? I don't even know what that means, right?"
It
Um,
meant go call all your family and friends and make them buy.
yeah,
Yeah.
welcome to yeah, I wouldn't even name the firm. Yeah, so I literally started my career as an advisor, cold calling through the Dana Point phone book, and it was a grind. It was rough, but ended up, building a few clients, and then within a couple of years, realized that my path really was not talking to folks about their hopes and dreams and planning. I was really fascinated by markets, market pricing, how things move, why they move. Technical analysis really was fascinating to me, much more so than work. Again, I was a young man. I was 24 years old, and it's very
Way
difficult
more so
for
than your brokerage bosses, I'm sure. Yeah.
yeah, so it's like, look, what was driving me and my interest at the time was markets, and fortunately, on the West Coast, we have a number of leading technical analysts and thought leaders. I will mention John Bollinger is a friend of mine. He was a great mentor for a while, but without naming a bunch of names, there's a community of folks out here that really had the passion to give back and to bring people along. And so what started off, as I think a lot of things do, what started off as what I thought was going to be a path of advisory really moved into money management. And so in the early days, we built strategies, very basic, trend following strategies that worked phenomenally well because markets were very different back then. Remember, when I started in this business, you brought a client on. The markets, when they closed at 4 p.m. Eastern, they're closed.
Yeah,
There's
you're
no
done.
after hours. There's no futures. There's no options. There's no ETF, 415 trading. That's it. Your Merrill Lynch broker in New York is on the golf course or at happy hour by then. So the pace of markets then was there was an official timeout.
You
I
don't look that old though. So it's that good California living.
I look good for 75. Let's just let's
Yeah.
just let's just go with that.
All right.
So markets, so basic trend following worked really well because trends needed time. People weren't trading on their phones after hours. I mean, think about the innovations we've had since then. I was in these markets before there were we were still in fractional trading. We've had decimalization, we've had ETFs, we've had inverse ETFs, we've had index futures, single stock futures, all of those things, derivatives, all those things that we wanted would give us more transparency, give us more liquidity. Those have the side consequence of those is that you get faster paced markets. I know we're jumping into markets while we were supposed to be talking about background, but
Yeah,
but
no.
back then that worked well. And as time went along, I found myself managing separately managed accounts and then SMAs for individuals and then institutions. That eventually morphed into, I mean, we licensed models for a while in like 2005, 6, 7. Eventually, that led to launching a series of mutual funds. And so, really, up until last year, for the past 9 years, I've been running liquid alternative mutual funds, traditional 40 Act mutual funds, running long short strategies, long short credit, long short equity. And then just recently launched Altus a year and a half ago. But started off 20, 30 plus years ago, and that's kind of been the path. That's how I ended up in Southern California doing all this.
And then, so you, for the private clients, when you first started getting into modeling, for lack of a better word, you were like trend following, this is working. And then
Yep.
are you saying that you saw the speed increase and it stopped working and then you moved to long short equity stuff?
It was
Or
more of
was,
an evolution. I wouldn't say it stopped working
yeah,
because we still use momentum and trend following as a core component of what we do.
yeah.
Um, I wrote a white paper a million years ago that talked about, well, let me back up. So trend following that became more bumpy, right? More volatile, more lumpy. The main complaint with trend following is you go through these series where you get these pullbacks in the middle of the trend, and it forces the investor or the manager or whoever to question, okay, is this pullback a new downtrend or is this just a pullback? You know, I know this is timeless
Yeah,
content,
yeah.
but in terms of last week, just recently, last Thursday, we had a President Trump tweet. You also had an implosion of some credit with Zion Bank, and you had this gnarly 3% beat down to the S&P. It's already gone. But at the time, right, we're already new highs on today's close. So is that, uh-oh, this is it? canary in the coal mine, right? So the challenge with trend following is that you're inevitably always going to get the short-term pullback, the counter trend opposite of what the macro trend is. And so it inevitably creates a challenge to stay invested. The challenge of short-term volatility trading is just the opposite. You can go through periods where you're up, 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 up and away, and there's no volatility, and then that's frustrating as well. So what I figured out in 2003, 4, something like that, was that trying to this is my philosophy, trying
Yeah.
to smooth out the returns of trend following. You can't do it with more trend following because these
Mm.
are the things that are part and parcel. This is part of the character of trend following.
Like, so if I'm like, hey, it's too much with this long-term trend following, I'm going to do short, medium, and long-term trend following to smooth
Yep.
out that journey.
Yep.
You're saying not so much?
Multi-factor absolutely works, and we do that as well.
Yeah.
But even on a short-term basis, so show me the example for Deep Seek Monday. What short-term trend following model had you hedged for that Monday?
Yeah, no.
None. What short-term trend model had you hedged for last week's 3% beatdown? What
Yeah.
short-term trend model had you hedged for the Powell misstep in December?
And if
December, the
they
S&P.
are they
Yeah.
really trend if they have that exposure at that point? Yeah. More
So,
blend.
so yeah, so our my object. So when you back up and as a quantitative manager, I didn't really get into that, but we're quants. We're based on math. We're based on price discovery. Um, our philosophy is this. Here's the way I can put it. The framework for our economic process is this. On a long-term basis, trend following works because markets are relatively efficient. Markets generally price on fundamentals. So if you put up a monthly chart of the S&P for the past 10 years, it will generally mimic what's happening in the economy, right? It leads the drawdown, it leads the top. 2007, the S&P topped, a quarter or two before we were officially in recession, right? You bought it in 2009, a month or two before the NBR came out and said, "Oh, we're officially out of recession." So on a long-term basis, S&P or Nasdaq or Russell, they are generally fundamentally driven on earnings, GDP, cost of capital, eat earnings, whatever. But when you move your analysis from looking at long term to months to weeks to days to hours, markets are highly inefficient and they're driven exclusively by investor behavior, by herding, right? And herding, in our view, is short-term tail risk. There's no trend. The herding trend on the long term works. So that's how we combine short-term volatility tail risk exposures and hedging with long-term trends. And the result is the two smooth each other out. You might call this return stacking. You might call this multi-strategy, multi-time frame. We come up with all these different ways to package it. But what you're really doing is we're exploiting as we deliver returns, the two things that we always want to be able to exploit things that are observable, measurable, scalable, and the things that we know are always going to be with the market. We will almost always have momentum and a theme and trends. There's going to be FOMO. There's going to be some sector. Right now, it's AI. It's recently biotech. It's energy. It's AI infrastructure. Right. It'll be a new theme in another couple of years. But then you're also always going to have short-term risk and short-term headlines. And so our process is get in line with the macro long term, but be prepared when that rubber band stretches too far, because
Mm.
it always does. To the
But
upside.
that's the $1 million trick, right? Like it can seemingly stretch in infinity, right? Like what's the old line? It can stretch longer than you
Well,
can hold it.
yeah,
To
yeah.
to
The old, the
paraphrase
old
the old line.
Keynesian quote is markets can remain irrational longer than you can remain liquid. Yep,
Yeah.
exactly. And so we have a series of quantitative driven measures of is the trend, are we currently too stretched? And these are, you know, proprietary models, but they're based around volatility bands. They're based on
Yeah.
cumulative tick on the New York Stock Exchange when you get these big tick bombs that's showing institutional buying and panic buying or panic selling.
Tick
Um,
bombs. I like that.
yeah, big
That
tick
that means
bombs.
something different up here in the Midwest, like you're in the
Yeah,
woods. Yeah.
yeah, yeah. No, it's not fleas and ticks bomb. And then we also look at we have some volume adjusted RSIs, some things that basically we're just measuring. Look, we're in the race car, we're ripping around the track, but the oil pressure is too high. We're revving out the engine temp is too high. something's going to break. And so the analogy I give all the time, which is probably not a great one, is there are certain times in markets everything is fine. The macro trend is in place, and we're fully in gear with that trend. We're benefiting from this momentum behavior, but there's a 2 year old running around the living room with a steak knife. Okay? I can't tell you exactly what's going to happen. I can't tell you what the headline is that's going to create a problem. But this is probably not going to end well, right? There's
Mhm.
a condition, there's a macro environment where everyone is on the same side of the boat, and so where we end up applying that is we don't short the whole market. We don't make a market call. We just take futures and we short against our core exposures and we bring the exposures down, let that trend reset, and get back in gear. So it's a process of continually adjusting our exposures to get in line.
That
Again,
was going to be my in the race. I don't know. I can't work it into the 2-year-old with the knife. I'll go back to the race car.
yeah.
Like, so the oil pressure side, do you pull over and park and wait
No,
for it to go down?
no,
Or
take the
it's
foot
just,
off the
hey, let's
gas.
take the foot off the gas a little bit. Let's slow it down. Let's let that pressure come back.
Go from 95% long, put some S&P futures against the core positions, hedge it down a bit, let things reset. And because our total objective is to deliver consistently positive returns, smooth and up to the right. Because at the end of the day, this is a conversation about where does a strategy like ours in a hedge fund or a managed futures account, where does it fit in an overall portfolio?
Yeah.
We are built. We want to be. We've proven it over and over and over again with the prior funds I've managed. We want to be that low correlation asset class that provides the diversification that everyone else is supposed to be providing. So there
Yeah.
are times where we have high correlation. I mean, right now, look, it's not bad to be highly correlated to the S&P right
Yeah. That
now.
means you're
Things
making money. Yeah.
things are going up, right? But when the volatility picks up, you want to be able to hedge that volatility down and be the one or two, three things in the portfolio that's truly diversifying and giving, whether it's family offices, other hedge funds, individual advisor, your portfolio construction. We want to be able to deliver that consistency of return, low drawdown, but high upside exposure to markets.
When we first started talking, I thought you were going to say it's basically a trend following portfolio, but are we saying this is only in the S&P?
No, so we are in S&P, we are in Nasdaq 100, we are in Russell, so it's basically U.S. equities. We want
Got
to
it, but only US equities, not a full-on trend portfolio.
no, no.
So,
That's where we're differentiated a bit. I think other folks in our space are trading they're trading the softs, they're trading a gold, they're trading currencies,
yeah.
trading equities. This particular strategy that we're focused on right now is purely U.S. equity. And the kind of the thinking there is that I think pretty much every investor in the world, the majority have U.S. equities in their portfolio, right?
Yeah.
So it's the most broadly has the potential for the most broad usage. If we can help solve that problem in a portfolio as we roll out other strategies and products, those will come secondary. But the ability to use my 30 plus years experience, we haven't talked about my mutual fund experience yet, and we'll get to that. But we've delivered consistently positive returns. I was at the desk in 2020. I was at the desk in 2008. We've sailed through those markets. If we can deliver that consistency here, as we build out a new company, a new asset management company, it will pave the way for other asset classes. But right now we're starting with equities because that's the most important one to get right in our view.
Yeah. And would you view that as, hey, this is equities plus, or like I'm trying to give you equities, but with half the risk or something of that nature?
We've generally speaking, since our inception, we've delivered basically very close to market returns with half the risk. Yeah, and that's the
Yeah.
objective.
Right.
Um,
So
yeah.
that's the whole game, man.
That's the
Um,
game is a more reasonable way to get access to equities, a way to participate in U.S. equities, but with a level of comfort that there's someone at the helm with a proven process to manage risk and volatility around that. And since we launched after running the mutual funds for 9 years, we launched Altus in August of 2024, straight into a 10% drawdown. I mean,
yeah.
we've had so many headlines over the past year and a half. It's pretty crazy. I mean, we went We launched the mutual funds in 2016. We went from 16, 17, 18, 19. We had a 20% drawdown in 18. But other than that, we went almost 3.5 years without a significant volatility event.
Yeah.
Since we launched
Right.
Altus,
17 was famously, right? Like a
I remember writing
record
commentaries.
number of days without 1% move or something.
Yeah, I wrote a commentary called "Let's Go Streaking," and it was about those streaks. Yeah, that's part and parcel. That's very descriptive of bull markets. A high liquidity driven, Fed supported, bull market. We're in a similar situation now, although there are some differences we could talk about. But going back to my point, we had multiple years of low volatility. Since we launched Altus 15 months ago on this new delivery of this strategy, we've had what, five major events? August was the yen carry trade. No one even remembers that now. But August 2024 was the yen carry blow up. S&P had about an 8-9% drawdown. Then you had Powell misstep in December. You had the AI Chinese AI
Yeah.
moment in January. Then you had the massive 20% drawdown, 15% drawdown in the S&P from February to the April lows. There's been a lot going on, I said, over the last 15 months. And fortunately, we've been able to deliver consistent returns through that process. So it's been a good environment for us to demonstrate our risk management and trend following. But those two concepts for us are inseparable. We will not ever do momentum without a risk management approach. And I don't think that you can do just short-term volatility trading on its own without participating in longer periods of momentum and trend. So they fit really well together.
And what would you say to someone try and put you like you're a timer? Are you timing these up and down moves?
No, not at all. And in fact, I was on the board to a couple of different timing companies, so I know that very well. No, so timing in my definition would be risk on, risk off. So one of my favorite games I used to play when I go speak at these advisor events, I'd always start off the conversation with, okay, show of hands, are we in a bull market or a bear market? And the punchline was, it depends on your time frame. Both are true, right?
Yeah.
So I think one of the biggest challenges for people who don't haven't built a framework this way is the human brain wants to solve for the simplest explanation possible. Always, that's how we're built, right?
Yeah.
Homeostasis, our bodies are built to be efficient. So, are you bullish or bearish? Well,
I
yes,
don't know. Yeah.
yes.
Both.
So on a we
Well, I feel like right now everyone is both. Like I have to be bullish in my positioning, but I'm bearish as hell. I think this can't last.
I've just seen this process over and over and over. And I coined a phrase a long time ago that I think is still relevant. You can tell me if you think it's relevant. Headlines change, but investor behavior is always the same, right?
Hmm.
So the headlines that created the panic, the catalyst for the panic in 07, 08, those headlines are very different than the headlines that created the panic and the catalyst of the 2020 decline into COVID, right? And those are very different than the tariff headlines. But how markets react to short-term news in the context of a longer-term trend, it's consistent. It happens over and over again. It's such a long-winded answer of why. Some of it has to do with how we deliver financial markets, like the business of an FCM or a prime brokerage or an ETF company delivering products. Some of it's just pure industry stuff about hedging and gamma walls and things like that. Some of it
Hmm.
is as basic as just following headlines and people getting over their skis. But
Risk
markets,
departments forcing people out. Yeah.
yeah, yeah. Volatility is a cycle. It's not a condition. A trend is a condition. A volatility is a precise moment in time, in terms of how we see it.
I'll push back on you a second there because we talked earlier, like it's getting shorter though.
The
So
the the
so it
compre-
may react the same, but is the timing condensed?
So I should mention this. So we're updating this piece about in 2015 or 17 or 18. I wrote a piece called the Bear Market Roadmap, and we'll make it available
Yeah,
to
we'll put it in the
listeners.
show notes. Yeah.
Yeah, and we're updating it now for current markets. But I spent a lot of time talking to, back then it was mostly retail advisors, because we were on some different SMA platforms. And the common question was, well, how do you make money in a bear market? Well, you have to start by studying bear markets, understanding how they work. Okay. Bull markets are defined by day after day after day of small gains. They're not volatile events. The VIX compresses, right? Liquidity is everywhere. Lots of correlation to the upside, lots of themes, but it's day after day after day because the investor, if we're talking about the retail investor or the advisor, some institutions, they're going, man, we had that bear market in '09 and '08. I'm not going in right now. And for a couple of weeks, you look like a genius. No, we're
Yeah.
hedged out. We missed that last 10% of the downside. And then what happens? Volatility calms down and the market starts going up day after day after day. And eventually that's where the FOMO and the herd kicks in because you cannot stand to be out of that market, right?
Yeah.
And it's kind of like the analogy of the we've all done it, a big wheel back in the days, maybe a wagon down the hill. Right? You start off maybe skateboarding, it's fine, and then you get a little faster. Then the speed wobbles start, and then eventually those speed wobbles get so gnarly, you're
Yeah.
disaster, right? That cycle is what momentum's all about, and that's what ends up becoming the volatility part of the speed wobbles is the volatility part. So when bull markets are low volatility, boring events, but all of a sudden you look back over the year, S&P is up 15, 18, 20%. Managers are behind, they start chasing. Bear markets are completely opposite. They're not consistent downside. So if they were the same, you'd have consistent day after day upside. Bear markets are consistent downside every day. It's not how it works. Bear markets are the most violent rallies and the most violent declines
Mm.
because the emotions are running so hot. The volatility is so hot. The option pricing is so hot. People are every night trying to manage their exposures and their credit. What's my overnight risk? The banks are talking to each other. So we wrote this piece called the Bear Market Roadmap, and I can't remember the exact dates right now. I think we went back to like 1950 or something, but we looked at what are the 50 largest one-day moves in the S&P from, it was like, I think, don't quote me, I think it was 1950 to 2017 at the time. And we're going to update this piece. But what's interesting is the worst days in the market every year and the best days in the market all happened when the S&P was below a 200-day moving average.
Hmm.
That's when the
Best
violence
days as well.
happens.
Yeah.
Even the best days, even the single best winning days in the S&P, and that's so counterintuitive, right? It's like, wait a minute, if you're in a bull market, you should be having these big ripper up days. No,
Mhm.
your biggest, like I remember 2008. I was at the desk when we lost Lehman Brothers. I was at the desk when I watched all the Congress people, Pelosi. They were all arguing about whether they're going to do cash for clunkers and the stimulus programs. And there was a big political standoff and you had a massive sell-off on that Friday. S&P was down. I think that week was down like 13, 18% in '08. Monday, S&P were like 9.5. No, I think it was like 11% on that Monday, right?
Yeah.
Because over the weekend, the politicians finally bent and okay, no, we're going to save some banks because we lost Bear Stearns, right? Bottom line is these massive moves up and down happen in bear markets, not bull markets.
Yeah. It's
So
also a funny aside, real quick, like everyone, oh, this we've never had news-driven markets like this in a tweet. Like go back to '08. That's all it
yeah,
was.
you want to see how much wine I was drinking on midnight when we lost Lehman Brothers? I remember
Yeah.
I was managing money for a large firm in Georgia at the time, and it was midnight their time and 9 o'clock our time because we're in California, and I'm like, well, we're hedged either way. We'll see what happens. I remember just sitting there watching Bloomberg and just watching this thing just melt, and that's when we
Oh,
lost Lehman. No one
yeah.
thought it was going to happen. So again, we've been through these cycles so many times, and the headlines are different, the catalyst is different, the setup is different. But look, how banks, investors, FCMs think about their capital. When you get to a certain pain point, those are the massive inflection points, and trend following by itself will never pick that bottom. The
Mm.
math doesn't work, right?
Yeah.
Even short term.
Well, I would argue by design, because if it's
Right.
trying to pick those bottoms, it won't catch the full downtrend or
Because
the full uptrend, right? It's by
you're
design,
exactly
it has
right.
to skip those. Yeah.
But by design, if you read any trend following book or you study anything, or you know this, you guys are in the space from
Yeah.
this is your entire world.
Or if you
My
listen to
world is
this
too.
podcast, yeah.
Well, the point is, by design, we want to ignore those. We call those short-term volatility days noise.
Mm.
Stay with the trend, ignore the
Yeah.
noise, right? Volatility trading in our book is trade the noise, benefit from that short-term panic, benefit from that. So the reason we were hedged for DeepSeek Monday is not because I have some, insight into Chinese AI. It's because if
Yeah.
you go back and look at markets, look at S&P futures, look at Nasdaq futures, in the week leading up to that, I remember we were down in Miami at the time for that iConnections event, and there was a Fed meeting that week. So I was telling my partner, I said, we're hedging down because we were at peak, tick bombs to the upside. All of our models, short-term volatility models, were screaming, we're over our skis. There is a chance you're going to move higher, but we've seen this over and over again. At some time in the next few sessions, some headline, some catalyst, you're going to erase multiple days of gains. It's what we've done for over 2 decades. We've seen this
Yeah.
over and over again. So I thought, I always put out a commentary. I bet I didn't because I would look like an idiot.
That the
But I
Fed would
thought it
do
was going to
something.
be, yeah, I thought it was going to be the Fed that week saying something wrong or being interpreted wrong. Powell, they don't like what Powell said and they're going to dump the market. But no, we woke up Monday morning. All of a sudden, there's a new super cheap AI solution, and all the capex
Mm.
spending in the U.S. is now irrelevant. And that was a 3% reset on the Qs. Cover the hedges, get back along, get back in gear with the macro trend. So the short-term volatility acts like a regulator around the extremes to try and give a better return stream than just multi-time frame trend following can deliver on its own.
Which I want to dig in that in a second, but it's interesting to me. Like part of me thinks like, oh, well, you were lucky because the models were protecting against a Fed announcement. It was some other announcement. But the other half of me is like, no, it didn't matter what the announcement was. Didn't matter if it was the Fed or DeepSeek or whatever or some bank. Like it
Yeah.
was so toppy and so overbought that any little thing, right, with the straw that
Yeah,
broke
no,
the
we're
camel's back.
quantitative. So I mean, look,
Right, but how do you view that of like, is it luck or like to my point, like it doesn't matter what the catalyst is, it's so overbought that it's just ready for something
yeah,
to trigger it.
it exactly. Like, I mean, a good example is this last Friday, or Thursday. We've been doing so well with China. The administration has been doing well. The market's kind of taken that out of the pricing scheme. We're starting to get overbought again, and out of the blue, the administration's using this as a negotiating tactic, and the market just was not prepared. So you create this air pocket, which then we're buyers. So we on that big sell-off last Friday, we're big buyers at that, because you went from, which happens a lot. You went from too much complacency. The VIX was compressed to almost 1 year lows, right? No one's taking it
Yeah.
seriously. You've got a stream of people on the news networks saying things like, "What could go wrong?" You're like, "Uh-oh, don't say that. That's
Yeah.
the curse. Don't say
I'll
that."
find something.
Yeah,
But
the
just
market.
to reiterate, you're not looking at those tea leaves and saying like
No,
it's
but
getting it totally
not at all.
quantitative.
We
Yeah.
are completely math driven, completely quantitative. These are rules and a framework of risk management that we put in place 20 years ago. And we've used in SMAs. I use it to win a 5-star Morningstar rating in the mutual funds that I ran. It's a repeatable, observable process. And let me tell you something. It's not always fun.
Hmm.
Last Friday, there's a look. If the market sells off 3%, if equities sell off 3% one day, there's a headline where you have to consider, wait, is it different this time?
Yeah.
Um, you don't get a 3% sell off on just like, I'm sure it's fine. No, it's a panic moment. But my job is to have the discipline to exploit that, right?
Yeah.
And it's not always easy, but I'll tell you this, Jeff, top secret. I hope no one else, everyone should off your monitors. Just this is between us. Don't listen.
Yeah.
My favorite trade is a panic Friday. If
Mm.
if if our models confirm that you go completely oversold, that is one of the now that I say this, I'll probably not make it true, but
Yeah.
it's one of the more consistent things you can observe, is when you have a panic Friday, you're exploiting people saying, the repeatable human behavior of, I don't know all the information here. The market is smarter than me. I want no exposure over the weekend. We'll sort it out Monday.
Yeah.
Everyone gets a break. They go to football games. They have a
And
glass of
isn't there a
wine. They go to the barbecue.
yeah, and
Monday
there's
morning,
a market axiom, right? Like the market bottoms on Monday, doesn't bottom
uh,
on a Friday. Yeah.
or they call it turnaround Tuesday as well. Sometime in
Yeah.
those days. So how would I also explain it as this? Trend following is a clunky brute force instrument. The trend is the condition, of the market. It takes, and in order for the math of trend following to work, You need multiple days to deliver a trend. Whether it's a 5-day trend, 20, 30, 200-day trend, whatever, but you need to compound that over time. And there are going to be noisy days in between. They're just not a part of the trend, right? But volatility trading, in our definition, while trend following is clunky, volatility trading is a precise moment in time. It's
Yeah.
a 1-day, 2-day, 3-day event when, yes, the trend is up, but statistically, you are exposed to a pullback. Whether that pullback is a 1% pullback or it's the beginning of a new nasty bear market, it doesn't matter
Hmm.
because we can harvest alpha over and over again by using this multi-factor approach. Our trend models and momentum models are going to deliver the return 80% of the time. But there are times where you really need those short-term swing trades on the volatility portion. And they're right within 2, 3 sessions by the math, by the definition of how they work. We only use those when the market's really extreme.
So let's dig into those. So that's using futures only options, VIX, all the
We
above.
all the above.
Yeah.
So a VIX compression is one of those things. We don't like to short VIX, but we will the VIX exploding higher is one of the conditions that why we went very long on that Friday meltdown. We look at volatility bands around these indexes as well. They're not Bollinger bands, but they're volatility bands because when you break out above or below these bands, the way we construct them, they contain 90% of the price movement. So
So
statistically, if
you're
you're out,
having wine with John Bollinger, and you're like, sorry, John, I'm
yeah,
not
I
calling
know
them
John's
Bollinger
gonna hate
bands.
me now. My phone's gonna start blowing up. No, listen, I'm a massive fan of John. We worked together on some different things over the years. He's a great guy, but he really help people, with his percent B and bandwidth and volatility bands. Um, I remember, well, we worked on a lot of stuff together. And he was a
Yeah.
great mentor to me in my early in my career. There's a number of other folks too that worked with him. That we're all
Mm.
kind of this little group of people that he wanted to pass on, technical analysis to.
It's going to, your goal is to hedge that downside by
The goal is
grabbing
to
little pieces of upside in between it and getting
so
back
so
out.
th so this goes back to that idea of being a market timer or exposure manager.
Yeah.
We're an exposure manager, right? So think on our return stacking of our 3 levels, right? So we're going to get in gear with our core exposure. Right now, the S&P, the Nasdaq, the Russell, they're all above whatever moving averages. They're all in our proprietary trend models. The trend is green. Get invested, right? If that was our only process, then we'd be forced to just sit back and take the beat downs every now and then. And for some CTAs, managed futures, trend
Yeah.
followers, that's totally fine, and that's the process.
Do you have stats on that? If you just ran your trend model on the indices, is it like,
Yep. Yeah, it's and
it's
it's
probably still good, right? It's
it's
probably still good.
good, but I think most investors will get shaken out,
Yeah, exactly. It's not an
Um,
enjoyable experience.
I
Long, if you
mean,
look at it on a 20-year basis, like, hey, pretty good.
look, that also works for buy and hold, right? So, I mean,
Yeah.
if you look at a
Yeah.
20-year, I mean, who were you 20 years ago? Were you making the
Yeah.
same investment? Are you going to stick with the same? This is human behavior. We're not going to stick with something
Same
for
guy.
20 years,
I had
right?
the same hairdo.
Yeah.
Yeah.
No, I know my hair is a lot longer now. So the if you had permanent capital, and you literally were managing money for yourself. You don't have clients. You don't care. You could use just trend following or
Yeah.
momentum. The reality is, we serve a lot of people who serve other clients, and they're not just one strategy. They want to see how can we add alpha, reduce drawdown, improve the portfolio. And when I started off in this business a million years ago, my first clients were professionals. They were doctors, dentists, lawyers who had already achieved a certain amount of wealth, and their objective was grow my money but don't lose it, right?
Yeah.
So I didn't start off from a place of I started in the 90s, so we're going into the dot-com bubble. A lot of my friends and other brokerage firms and things were all shooting for the moon. They were all buying. I could list all the tickers. I kind of, by mandate, who I was working with from day one, risk management, controlling downside is just baked into what I do. I can't do anything else.
Mm.
That's just how I function. And so the volatility management is about getting investors involved and getting them into something that will deliver results over time, but not have that moment to get shaken out. Because the reality is, even any strategy. volatility trading, momentum, pairs trading, stat arb, whatever you're doing, multi-commodity, diversified, whatever. There's going to be moments where you have volatility. If the volatility is tolerable, you'll be there for the incredible upside, right? But if you panicked at the April lows this year, you missed a 30% run.
Yeah.
Right? So when you have a discipline proven model to say we've officially gone down too far, it's time to cover hedges and step in. That can help smooth the experience and keep people invested for what you hope they're there for. You hope they're there for the upside. But if the drawdown and the volatility is too high, people won't be there for the reward. That's been
Hmm.
my experience over the last 30 years.
Talk through how the hedges actually work one more time. So without giving away too much of the
Yeah,
secret
so no,
sauce.
we're looking at we've got 6 or 7 models that look at different price points. It's all price driven, because at the end of the day, the narrative doesn't matter, the fundamentals don't matter. Investors vote with their wallet, right? For us in our world, price dictates exposure. So when we are in an uptrend like we are now, we are fully invested until we get too far over our skis. And those volatility models, we package that, but volatility for us can mean too little volatility as well as too much volatility.
Hmm.
So when volatility goes away, the VIX is compressed to 1 year lows. You're breaking down, you're up above our volatility bands, we call them. Our volume smoothed RSI is screaming. All those things are red lights going, hey, this has been great, but the party's gone on too long. There's an accident coming. Doesn't mean the trend is over. Doesn't mean you're not going to reset and go higher. But there's an opportunity for two things: extra return and alpha, and also smoothing downside. That's how we've been able to deliver 80-90% of the upside of the indexes with half the volatility, half the risk, is because this little short-term process is monitoring, are we too fast, are we too slow in context of the trend, right?
But
And
you'll
that's
also dial the trend piece down, the
no,
trend exposure. No, so that
no.
just exists. And
Because
now
our
I'm
margin of
adding these
equity,
hedges. Yeah.
yeah, because of the power of doing this, and that's, I should say this, this vehicle too, being able to do this, I'm having so much more fun doing this in managed futures and private fund, because the mandates that you have in a 40 Act fund and the rules around the SEC about what exposure that you have to have really dampens and limits what you can do. So with the margin to equity of futures and our ability to change exposures, we can keep those core exposures on and use futures to dial up and increase the exposures, or hedge against and get neutral. And the tax efficiency of futures makes that just it's just an ideal way to execute this strategy.
Yeah.
Other strategies, single stock and fundamental bias and the AI trade might be great for ETF or mutual funds. For us, going back into where we have no SEC restrictions in terms of can we be completely neutral? Do we have to have this exposure, that exposure? The returns have been phenomenal. We've had such a better vehicle to execute the strategy in.
Love it. So the nine you said in the hedge, 9 inputs. What was the nine?
I just said 6 to 7. I always say that for some reason. I think there's seven inputs measuring different, like I said, cumulative tick, our volatility bands, and it's around each one of those too. So we may have times where it gets really fun, and one of the reasons that we can generate multi-factor smoother returns is it's not that market timing risk on, risk off. We might be short Russell
Mm,
against a long S&P because the whole market has been coming up. You're getting this Russell reinflation trade that's happening right now. We're expanding because the cost of capital has come down. Small cap stocks have to borrow a lot of money, right? They don't have the massive profits. They don't have international profits. And so in our experience, small caps tend to have the most interest rate exposure in terms
yeah.
of dampening. When the Fed started cutting rates, and now that the market's getting a narrative where it believes that the Fed's going to continue cutting rates, you're getting this expansion of Russell. So Russell has been getting a lot more violent lately, and it's been getting up above and hitting. So we may have a time where, okay, the
Mm,
macro long-term trend is green across the board, but Russell is a little over the skis here. So we're short Russell, but we're still long S&P and NQ. What that does is on a down day, if Russell's down 3%, but S&P is only down 1%, we're almost neutral exposure, but we're still making money on that day.
mm.
So we can make money on the trends. We can make money on the spread of performance between the positions. And then we can also make money on the volatility or lack thereof.
So all those hedges are working independently in those
independently.
three markets. Each of them will signal, hey, this is
Yeah.
getting crazy.
We're measuring trend and overbought, oversold on each one individually, and they're functioning differently. That's why our exposures, we can be, we came in today, 68% long. We added some exposure. We're going to into tomorrow 90% long. In a couple of days, if this thing we're coming into the end of the month. There's a lot of factors this week. I don't know when this is going to be put out, but this week we've got a bunch of earnings. We've got CPI, we've got Fed coming up. The Fed's in its blackout period, and now we're going to the October 31 mutual fund selling, tax loss harvesting, all kinds of
Yeah.
awesome things to exploit in terms of volatility and trend. Meanwhile, you have the S&P pushing, 12, 13, 14% year to date. We're Here we are again. We're back to that same part of the year where a lot of managers are going, man, I'm behind the S&P again. And so that exacerbates the moves and you begin the year-end chase, which inevitably leads to the whole cycle repeating over and over and over again. Yeah.
How do you view it as compared to like, all right, I'm going to be long. I just hold my long. We'll start basic 60/40. Seems pretty obvious compared to that. So maybe we skip that one. But if I'm like, I'm going to add tail risk, right? I'm going to have my long equities and just tail risk with like 20 or
Yep.
30% out of the money puts.
Yep. Yeah.
What, how would you compare to that? Because you're saying, well, those are only have one single path where they can
Well,
do
the,
well.
the 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 problem. So if you're comparing to like a buffered ETF or like you just sit kind of with those exposures, like I'm a 30% long tail. The problem is those are we call those collar positions, collar trades. You're permanently limiting your upside, right?
Yeah.
You're protecting
Well, I'm
against your
saying no,
downside.
not a collar. If I'm just right, I'm 80% long stocks and I just hold 2% long tail risk. Right.
Yeah.
I just keep buying those puts, rolling them month over month.
I
So it's
mean,
a
it's
it's a
a
guaranteed
complicated answer
drag.
because it depends
Yeah.
how far out of the money those puts are, depends on the daily pricing. How I've seen most of those strategies work over time is that the protection only kicks in if you have a blowout event, 1 or 2 day event, but you're still gonna suffer the 2 to 3%, a couple of day drawdown, because those deep out of the money puts just don't, you're not up there far enough yet. We do look at those. So it's not quantitative. It's more just I've been a manager for 30 years, and so I'm passionate about markets and I watch and pay
Yeah.
attention.
Yeah.
So we look at the gamma walls, we look at the delta walls, we look at what's happening in terms of skew. We look at all those things as a secondary indicator. But the difference is, I would say, that type of strategy is okay. It serves a purpose, but that's going to have a fixed correlation. You're going to get so much downside, but you're only going to capture so much upside. So you'll be held back all the time. Ours is a dynamic exposure management. So there are a lot of days out of the year where we don't need that put. Volatility is
Yeah.
low. We're compressed. We want to have full exposure to markets. We want to deliver the return of S&P, Qs, Russell. When the volatility picks up is when our hedging picks up. So there are times where we just look like the market, which is okay with us.
Yeah.
But
Hey, it's usually yeah.
yeah,
Um, and point of confusion for me here, if the market does go, say we do have that 30% down and the trend reverse, it's now a short trend in all those markets. You're flat, you're out, or you
we
short.
are a net short. Yeah. So
Got it.
so the whole process is now
So
a
the
mirror.
trend is now short and
We're
the
gonna
alpha piece is still
Yep.
working.
Start from the top. We're gonna get the core positions in line with the core trend, right?
Yeah.
We're gonna get short those equity indexes. And then as we now start to reach oversold, we'll cover those shorts and get long, and we'll be buying those dips as you bounce on the way down.
Mm.
And
So you'll
per
be getting longer quicker because you're not waiting on the trend. All the alpha pieces are kicking in,
Yep. And if we go back to where I talked about
which you call
the
them what? Volatility trading pieces. I'm
yeah,
calling them alpha
volatility.
pieces. Yeah.
Yep, volatility triggers. Because remember our discussion about bull markets versus bear markets.
Yeah.
In bear markets, the most dangerous thing to do is to be short for too long
Yeah.
because they're violent oversold rallies. And there's so much opportunity for my favorite market is a bear market because we're busy. I'm not surfing at 2 o'clock in the afternoon because we're trading. There's a lot to do, but everything speeds up. And you know, again, if take a look at our piece, and we use 2008 and 9 as an example of this is a typical path for a bear market. Everyone forgets that you had 20-30% rallies from mid 2007 to 2009, yet overall the market finished down like 50-54%, right?
Yeah.
So it's bear markets are very exploitable. We had a little mini bear market last February, March, and April, and it's a good example. There was a period of time there during March where we were really rolling, and our core models went short, but we were short for a week and a half, and then you began to reach just panic oversold, where our models are going, yes, the trend is now to the downside, but you're so far oversold. You're so panicked. Now the tick bombs are to the downside. Now the
Mm.
VIX is exploded above its upper volatility bands. All the opposite. You covered hedges, you get long. We were one day early off the bottom. I remember exactly where we were. We were in Palm Springs for an event. And I remember, I think I was actually talking to Bobby about something that day, and he was at another event, some conference, and I was telling about our positioning, and you know, it was like, wow, I said we're buying this, we're covering shorts, we're getting long, and when 24 hours later, that was the low, and the market had that 12% up day or whatever it was. So the headlines changed, but investor behavior is always the same, right? So you're either in a bull market where you're taking advantage of the momentum to the upside, but using short-term volatility to hedge, or you're in a bear market and you're short, but you better be quick because those rallies come fast and hard, and then once it's relieved, you get back in with the trend.
And then those could also just get neutral at the bottoms, like towards the bottoms. Doesn't have to
They
be
tend
long. Yeah.
to, that's the power I truly believe of what we do, because when you're using just momentum trend following, even multi-time frame, you need multiple days of moves to get in gear and change your positioning. But market bottoms and tops don't work that way. They tend to work themselves out. It's a couple of big up days, and then like,
Yeah, yeah.
you know, and then you get a couple of down days. When you're able to apply short-term mean reversion volatility trading to complement the momentum trading, you just have your opportunity set is just so much wider. Your opportunity set to deliver returns is wider. And so because they're all of those independent, think of these as like independent strategies inside the entire portfolio. Russell might be oversold, but S&P is not. So you're buying the dip on Russell. S&P's not down there yet. So all of these tend to work together to create a smoother topping and bottoming experience. And listen, we're not perfect. There's times where, if the market is fully in gear and it's ripping and we're doing little hedges along the way, we're gonna not perform. We're not
Yeah.
gonna do 150% of the upside.
I was gonna ask, like a 17 would be bad for you because it's
Seven,
like,
no, 17 was a great year for us.
oh, because
Um,
there's no blips. It's just
It
super
was
smooth.
there was I think in 17 you had a correction into October that our models picked beautifully. 18 was more challenging, but 18 we finished positive while the market was negative.
Yeah. But I'm saying,
Um,
like, what type of environment? Something where it's a big rally, but there's a lot of there's false volatility spikes, basically.
well, so you're asking what's our best environment or our worst environment?
Worst.
Oh, dude, 2015. Are you kidding me? I remember that
Okay.
like it was yesterday. So 15, we were doing SMAs back then, hadn't launched our mutual funds, and we brought on this about a $400 million allocation. We were super excited. We're doing backflips. We're going to Javier's, and celebrating, margaritas all the time. And the market did nothing for 15 months.
Hmm.
I think the only return for the S&P for the entire 15 months was the dividend. There was no volatility and no trend. So in a flat market, no one's making money, and we're not either. You just didn't have enough extremes, and that was going
And
into
the
the first.
volatility train get chopped up a little bit.
Both of them did.
And the
So
trend. Yeah, yeah.
the trend following is just kind of whipsawing back and forth, like for everybody, and the volatility trading. But it was such a narrow. You didn't really get the big extreme sell off or the big extreme upside.
Yeah.
I'm not going to say we'll never have a mark like that again, because then it'll start tomorrow, obviously.
Yeah.
But I think where we are in the world, in terms of central bank intervention and crypto now being a real currency, a real factor in trading. I think there's some moving parts now where it'll be very difficult to not have some volatility to exploit. It's possible we get into that environment, but if you're looking where a strategy like ours can struggle, we're exploiting momentum and trend and volatility. If you have neither, what are we doing?
Yeah.
It's very
And
challenging.
it's almost not just volatility over here. It's like gamma, more of a gamma trade, right? Like you want,
Yep. Yep.
um, what do you view it like that? Like you're gamma scalping on that volatility trading side?
Pretty much, yeah. We're exploiting the skew. For example, tomorrow, I think VIX futures expire tomorrow, so you finally have the spot and the futures coming together. Both of them today are down 2.5%. Sorry, 12.5% off that spike from last week. But as you roll the contract now to November, you're going to see that November contract get pushed out again, and it'll be much higher than the spot. So
Yeah.
yes, there's also that factor that we have to pay attention to, and we watch a lot.
Awesome. What do we miss?
I don't know.
Yeah.
Talk about music, DJing, yeah, surfing.
Yeah.
I don't know what else we can talk about. Yeah,
I see maybe your wedding picture behind you, and got a
yeah,
shout out to your wife, who I've had the pleasure of having dinner with both of you twice, who's
yeah.
a just killer in her own right, in a good way.
Amy's
Yeah.
phenomenal. Amy, yeah, we've been married for over 2 years now, and she is a financial professional executive in her own right. JP Morgan, head of national accounts, JP Morgan, State Street. Yeah, very accomplished. She basically helped kind of build the ETF industry. I think she was employee number 5 or 6 or something. Don't quote me on it. When JP Morgan started launching ETFs. So no, she's a UC Berkeley grad, incredible partner. Yeah, thanks for mentioning that.
Um, right, as I said, a killer. And then your son, which I got to mention, he's doing some work for the firm, right? And has become a
Yeah.
bit of a quant. Was it like a
Uh,
reluctant, as my son's looking at colleges and stuff? I don't know if there'll be any jobs in the future, so I'm a little worried about it.
yeah, yeah.
So was
Even for
he a
us.
reluctant participant, or how'd that work out?
No. Look, my son saw what I was doing for a long time. He's one of my best friends. He's a great kid. Not a kid, he's a man now. He wanted to follow in the footsteps of his dad and do money management. So we talked about our process of multi-factor risk management for years and years. He was trading on his own. Went to UC Santa Barbara. I had no idea how well he was going to do there. Ended up getting himself into one of the Dean's investment group, where he was managing a portfolio there. He's meeting with boards of companies, getting recruited, and that was part of the decision making for me to do one more run after running my last firm for 30 plus years. Decided to launch a new firm, and so Ryan is my partner, and he's a great partner. The kid is a better quant than I am now. He's surfing better than I am. He's playing guitar better than I am.
Oh
So,
man. Yeah.
not happy about it, but I'm happy about it.
What do you have
Yeah,
left? You don't have it.
yeah,
Yeah.
yeah,
Can you
right.
take him in anything?
Yeah. Listen,
Yeah.
I still take him. Come on,
Yeah.
don't tell him nothing.
I love it. All right, we'll put some links in the show notes where everyone can find you and all that. And I think we'll leave it there. Thanks
Yeah, well, thanks
for
for the time, man. Great conversation.
uh, ditto. We'll see you next time out there.
Okay. All right. See ya.
All right, thanks, Eric.
Bye.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.